Hi, Lenore back, and I'm picking up where we left off. I just want you to know that I added a little bit more information, the debit to cash that was received from the long-term asset, which is the equipment, but I wanted to write that in so that that corresponds with the information I gave you before, that cash received from a long-term asset goes under the investing activity. Now I put together these two pieces of information, but there are two other journal entries, or excuse me, T accounts that I should prepare. Because I have a sale to the equipment, that's going to affect the property, plant, and equipment account because we sold something. So this $87 of increase is not actual, or excuse me, reality. And because we sold something, this increase of $12,000 is also not reality. What do I mean by that? Well, there is additional information hiding behind these two numbers, property, plant, and equipment, and accumulated depreciation, due to the fact that the company sold equipment and therefore it also affects accumulated depreciation. I'm going to create a T account for property, plant, and equipment. Because I need to determine if I sold property, plant, and equipment, that's going to be, as you see, a credit to that account. Therefore, the straight purchase of property, plant, and equipment will not equal this 87. Instead, 87 is the change, which has the embedded sale and the embedded purchase included in it. Let me show you what I mean. I know sometimes when I say things, it doesn't seem to make as much sense until you see it in place. Ooh, I totally put that line in the wrong location. Should have been on the left border. So I've got a T account. I've set it up for property, plant, and equipment. Let's grab the beginning balance, which is $500. And let's put in an ending balance, which we're given. Again, you always want to leverage what you know, and we're given these two balances, the beginning balance and the ending balance. We just calculated this journal entry, or prepared this journal entry, so equipment is indeed a category within property, plant, and equipment. So I need to indicate that there was a credit of $7,000, and this was the sale. I'm going to write this on the side. That 7 is due to the sale. So once again, we're going to do the math similar to how we did it here for retained earnings. I'm going to take my beginning balance and I'm going to subtract the credit, and that number, if there were no purchases, should equal the ending balance, which it does not. That lets me know that there were purchases made in this account. Could have been property, could have been more equipment, could have been land. That's not as important as there were a purchase. So purchases to this account will always be a debit because this account is increased with a debit. So here's where we need to figure out, well, what were those purchases? I will begin with the ending balance, $587, and from that I will deduct this number, which comes from the beginning balance less the credit. So that's $493. Whoops, I need to put my minus sign in there to let Excel know I'm trying to subtract these two numbers. And hopefully this number, it represents the purchases. What do I mean hopefully this number represents? Sometimes when I put in formulas or I'm working with my calculator, I make mistakes. So I always like to double check it. Let's begin with the 500 that was given. We're going to subtract from that the 7, which we know from our journal entry was sold. Then I'm going to add to that the number that I calculated, I believe is the correct number. And if this is correct, this 94, then what I'm calculating will equal the ending balance. And it does. So now I've been given another piece of information, and that is that the purchases of property, plant, and equipment, which you remember will go under the investing section, is $94,000. And the difference between the 94 and the 7 will equal the increase that we saw on the balance sheet. So let me do that real quick to prove that. Less the 7. That's the increase that we saw. But behind that number are these two different situations. An increase of 94 for equipment and a decrease of 7 for the sale. Now, as I said earlier, because we have the sale, we need to do 2 T accounts. One for property, plant, and equipment, and the second for accumulated depreciation. So let me quickly prepare a T account for accumulated depreciation. Now you'll notice we're not given depreciation expense, but we will calculate that using this T account. So accumulated depreciation is a contra asset, meaning that it increases and decreases with a credit. So let's put in our beginning balance. We always leverage what we know, and that is $347. Although it's shown in brackets on our balance sheet, that just indicates it's a credit balance rather than a debit balance. And now we're going to put in our ending balance, which is $359. Now, items that decrease accumulated depreciation are disposals of equipment. As you see here, we have a debit of accumulated depreciation of 1. So I'm going to put that in, and this is initiated by that journal entry, which is the sale. So just write it over here. So that's why we have a decrease of 1. The items that would increase accumulated depreciation are, it's not items so much as it's the depreciation adjusting journal entry. If you remember that from your adjusting entries back in financial accounting. So this is the adjusting entry. So we need to figure out, if we begin with 347, we subtract 1, and we end up our ending balance with 359, what is the adjusting entry? So 357 less 1 equals 356. The difference between 356 and 359, no, I said that incorrectly. I better just use my Excel. So I have 347. I'm going to reduce it by 1 because of this 1. And that's going to equal 346. The difference between this 346 and 359 is going to be the adjusting entry. So 359 less 346 is 13. That indicates that the adjusting entry made for the month or the year totals $13,000. Let's double check that with the beginning balance, which is $347, less 1, which is the debit, plus 13. And again, if I've done this correctly, this number will be the same as the ending balance of $359. Voila! So this gives me another piece of information, but it's not as clear, only because this is accumulated depreciation and it's also a credit. So let me write in what we have just determined. So we know that there is a credit of $13,000 for accumulated depreciation. Remember, this is our depreciation adjusting entry. The debit that corresponds with this credit is always to depreciation expense. So if you remember this journal entry, this additional journal entry, the depreciation journal entry is always a debit to depreciation expense and a credit to accumulated depreciation. Like a detective, if the credit is 13, therefore the debit is 13. And we need to know what the depreciation expense is in order to complete our second line in operating income, or excuse me, operating activity for our statement of cash flows. So I've now completed all the prep work, or if you're a fan of cooking shows, all the mise en place for our statement of cash flows. And all this information came from the balance sheet and this information here. So with that said, I'm going to stop the podcast. You can do this on your own, and then I'll show you how to prepare your statement of cash flows. That said, Lenore out.